To get things started, the legal side of Avalara has asked me to say this. While we hope you'll find this discussion helpful, this session is for informational purposes only and is not legal or tax advice. So I'm sure the attorneys are happy. I'm Joel Wright. I am a strategic alliance manager at Avalara. I've been here for 4.5 years. I happen to have the pleasure of working with micro accounting and have for several years now. They're a great partner of Avalara's. If you haven't seen us, I'm not on webcam today, but I am wearing orange. If you go to any conference, you will likely see us because we stand out like a road construction crew. We're bright orange. So we try and make taxes less taxing. You may have seen some of our commercials. We're now in mainstream television networks presenting our solution. We're here to make taxes a lot simpler for businesses and helping by automating your tax compliance by connecting to your ERP or e-commerce sites or any solution in which you're creating invoices or building invoices, making sure the tax calculation is correct, collecting exemption certificates, filing returns, essentially just making it on autopilot so that way you don't have to worry about it. So today, what Laura had mentioned is we're going to run through essentially the highlights of a piece of content that Avalara produces every year. It speaks to tax changes across the globe. We are based in the US, so there is a heavily emphasized portion of the report that is based on industry in the US, some of the tax changes you may come across, but we do touch on global tax changes as well, because as we know, the taxes across the globe can impact our businesses here in the States as well. So as far as the agenda, again, I'm just going to talk to some of the highlights that are in the report, which Laura mentioned she's going to send to you once this webinar has finished. But we're going to talk about some of the economic nexus laws, things that happened in 2024, retail delivery fees, taxation on digital goods, electric vehicle tax credits, e-invoicing in the world, and the latest news in trade and tariffs. So I'm going to go through this. We only have 30 minutes today, so I'm just going to touch on some of the highlights of each of these items. If you do have any questions, feel free to post them in the chat and do my best to help you out with those as well. So economic nexus thresholds getting simpler. Believe it or not, sales tax in the US is making some changes to become a little bit simpler. It's almost like an oxymoron, simple taxes, but we are seeing some of these states making changes with regard to economic nexus. And if you're not familiar with economic nexus, essentially it started in 2018 whenever the state of South Dakota took Wayfair, a major marketplace, to the Supreme Court. They took them to the Supreme Court because Wayfair was selling goods into South Dakota and they were not obligated to charge tax. And so South Dakota home businesses, businesses that are based in South Dakota, had a disadvantage because they had to charge tax while Wayfair did not. Ultimately, that Supreme Court case landed in the favor of South Dakota, which introduced what we now call economic nexus. Previous to this, it was just wherever you had tangible personal property or employees, you had physical nexus. So where you had things, people, then you were obligated to register with the state and begin collecting and remitting sales taxes to those. Now with economic nexus, we look at revenue activities. So as you see here, this is the latest map as of January 1st this year. You see many states have just a revenue line item. So looking at total gross revenue of 500,000 in say Texas or California. If you're a remote seller selling into those states and you exceed that limit, then you reach economic nexus. Some states have 100,000 or 200 transactions, but as you can see, Connecticut threshold is 100,000 and 200 transactions. New York is 500,000 and 100 transactions. So having to keep up with that activity is pretty complicated. You know, it's not like you're counting line by line how many transactions you have in a state on your in your day-to-day processes. So it's something that you would have to proactively, you know, produce a report out of your ERP, kind of, you know, get the number of lines and then make those decisions on how you get registered in those states. So it is a complicated matter for businesses in the US. However, what we are seeing is that they're trying to make it a little bit easier. So Indiana, Wyoming, they're doing away with their 200. They did away with their 200 transaction threshold. So Indiana in January of 24, Wyoming in July of 24. Alaska, although they don't have state economic nexus, they do have local jurisdictional state taxes. And in those jurisdictions, they had a 200 transaction threshold. That's now done away with as of January of this year. And New Jersey is also looking, they have a bill in front of their legislator, Bill S 3604, to try and remove their 200 transaction threshold. So this is going to be a trend I think we continue to see. You know, not to get too into the weeds here, but the transaction threshold is kind of lopsided, I guess is a good term to define it, against why South Dakota versus Wayfair ever came in place. I mean, South Dakota took Wayfair to the Supreme Court because their businesses in the state of South Dakota were at a disadvantage. Whenever you place these 200, you know, these transaction thresholds, essentially, it has nothing to do with revenue. So you could sell 100 pencils or 200 pencils in Wyoming before this happened, let's say, and you know, it's $1 a pencil. So you sold $200 worth of product in Wyoming, and you know, you exceeded that transaction threshold. So now you got to register to collect sales tax in that state. So it had nothing to do with revenue. And so I think that's why some of these states are getting some common sense and doing away with it. We'll see as time moves on, but there's definitely some momentum behind states getting rid of the transaction thresholds. So movers and shakers on the 2024 ballot. This has a lot to do with tax rates on property tax, some other corporate taxes, but essentially, you know, North Dakota took a new bill for property tax that would basically charge tax based on assessed values. That was rejected. South Dakota repealed grocery taxes. Oregon denied a measure that would have imposed a corporate minimum tax on gross sales. So really nothing to worry about those. They were all rejected. However, Nashville did increase their sales tax rate to 9.75% to fund transit. So if you are calculating taxes manually and you have Nexus in Tennessee and you're selling it in Nashville, you want to make sure that that tax rate is updated to 9.75%. Louisiana is going to raise, or did raise, its state sales and use tax rate from 4.45% to 5% at the beginning of the year. So that's a pretty big hike, over you know, 0.5% there. The projection here is that in 2030 they're then going to reduce the rate to 4.75%. So that's obviously 5 years from now. A lot could change, but that's what is being proposed at this point. They also passed a bill that would extend sales and use tax to digital products, which are, you know, online games, any sort of digital marketing products that, you know, you are having on either websites or through the App Store, or, you know, potentially on social media. So they are looking to begin charging sales and use tax on those things. More states are considering retail delivery fees. Not sure if you've done business in Colorado over the last few years, but Colorado was the first to implement what's called a retail delivery fee, or what we call RDF. I believe they started in 2023 at 20 cents. It's now increased to 29 cents. The whole thought process behind these taxes are essentially to help offset the cost of maintaining roads within the state, because as we know, Amazon trucks are all over the place. They're using public roads that are maintained by the state or county or cities. And so these fees are put in place to essentially offset that cost and charge businesses for actually utilizing the roads. Minnesota implemented the same thing, only it's 50 cents in 2024. There's some exceptions here based on how much revenue you are doing within those states. But essentially, looking forward, there's at least 6 other states considering these retail delivery fees, which are listed up there at the top right. It looks like Washington is looking to move pretty quickly with that, with a 30-cent fee. So these fees are not taxes, they are fees, and it is something that you need to be able to charge your customers on if you are using those public streets within those specific states. Taxation on digital goods and streaming. So streaming services like Disney, Netflix, Prime, there's, I feel like hundreds of them out there nowadays. A lot of these cities and states are looking to impose taxes on those. Currently, the city of Santa Barbara in California is in a battle with Disney over $640,000 for utility users tax. Massachusetts and New York are also looking to introduce bills this year. It says 2024, but those have been postponed to this year on the same thing. So just streaming services. Not sure if that really affects anybody here. Not sure if Disney's on the call. If they are, my kids love it. So updates on taxation of digital goods. So we just kind of talked about that with Louisiana with that House Bill 8. Georgia started taxing select digital products in January of 2024. Michigan is adding guidance on taxability of NFTs or non-fungible tokens. That's all in the crypto world, using blockchain stuff that's over my head. But essentially, if the non-fungible token represents ownership of tangible personal property, it's taxable. Vermont enacted a new bill to include pre-written computer software such as SAS in its definition of taxable TPP effective July of last year. So if you're in Vermont and let's say you're using micro accounting with, let's say, Sage Intacct, then you should be paying taxes if your renewal is past July of last year. The electric vehicle tax credits may be ending. So as you know, many states introduced tax credits for EVs to try and move closer to an emission-free world, essentially. So it's kind of interesting here. DC, our nation's capital, is looking to eliminate the preferential tax rate for electric vehicles in DC. If approved, then EVs will be taxed at the standard 6% rate. Pennsylvania eliminated its alternative fuel tax on electric vehicles and replaced it with an electric vehicle road user charge. So instead of, essentially a credit, they're just moving it over to a road user charge. And New Jersey will gradually end its sales and use tax exemption for zero emission vehicles. The latest news in trade and tariffs. So this is almost like a John Madden play-by-play because it's just all over the place. But obviously, if you've tuned into the news recently, you've seen that tariffs are all over the place. We're looking at tariff everybody and nobody at the same time. It's been something fun kind of at Avalara since we are in tax. We do have a solution for cross-border. So if you are importing goods, if your business is importing goods and you need support with calculating tariffs or duties, we do have a product that could help automate that. Well, essentially, our team has been just locked in with every day with everything that's going on with Canada, Mexico, China, and the globe and the United States around tariffs. In fact, we actually have a webinar series called Tariff Tuesdays, in which we spend 30 minutes talking about what's new with these. So I will just say right now that these slides are slightly outdated, simply because these are notes from the report that you're going to be receiving. We do have blogs on our website. You can see some of those resources here at the bottom of these slides that have more up-to-date information. But essentially looking, this is the week of February 27th. A lot of things have changed. March 4th was a major day in which tariffs were going to go into effect with Canada and Mexico. If you kept track of it, there's a de minimis solution that's always been in place with Canada and Mexico. The U.S. Canada-Mexico trade agreement essentially had a de minimis, meaning that if you're crossing goods that are less than $800 and there's no tariffs or duties on those goods, we've been looking to waive those, but yet now there's a pause. But essentially right now, 25% tariffs on all products from Mexico were to take effect March 4th. I believe that's now been pushed to April 3rd. So, what is today? 2nd, so tomorrow. 25% on steel and aluminum articles from most countries set to take effect March 12th. February 13th, Trump signed a presidential memorandum to pursue reciprocal tariffs on U.S. trading partners. So we know we look to tariff cars and automobiles from the EU. Then the EU reciprocated and said they were going to put a 50% tariff on U.S. alcohol. Then Trump went back and said 200% tariffs on all European wine. And so, I think we could all kind of understand that this is being used as a negotiation tactic to get some terms that we're looking for the country. We just kind of slate these things to continue to be ever changing as this all gets kind of flushed out. However, if you are in the importing business or if you're exporting to other countries, definitely tune into Avalara's resources, because we are doing the best job we can of providing up-to-date information on it. And certainly if you are doing those things, I would highly recommend looking at our product for cross-border solutions to have real-time, up-to-date data with regard to orders and tariffs. So, just speaking about that product, our team, I believe, is over 60 people that are just keeping these dates updated, these dates and amounts updated. So again, if this is something that you're dealing with, please contact your account manager at Micro Accounting. They'll get you in contact with us, and we could share some more information on that product. The other thing that's happening globally is something called e-invoicing. So e-invoicing is, let's say you're in Brazil and you're wanting to buy a cup of coffee from a local shop. That point of sale system in Brazil essentially has real-time connection to the Department of Revenue for Brazil to submit the transaction to the government, get a confirmation number that the tax calculation is correct, and in milliseconds send it back to that point of sale to verify it. So it's essentially real-time auditing of sales tax with specific governments. So currently, 80+ countries have e-invoicing mandates. Just last year around this time, I believe we had 60. So in a year's time, over 20 countries have added e-invoicing. So it's something that is happening globally. In the United States, I feel like we would probably be one of the last. Personally, just kind of knowing how much we like to share our revenues with the government. We love Uncle Sam, but we don't want to give him our money sometimes. So I don't know if the U.S. will ever come around to e-invoicing, but certainly if you are doing things globally and you're selling into, let's say, Saudi Arabia, you will need to have a specific invoice to comply with Saudi Arabia's government. And so what Avalara is trying to do is, through our partners of working with ERP and e-commerce and billing systems, be able to have a formatted invoice that complies with all of these 80 countries to make it simple for you to do business globally. If you do have any questions specifically on any state, we'll be happy to get you more information on it. If you're looking to grow your business into some of these countries, I don't know why I said state earlier. If you're looking to grow your business into any of these countries, please let us know. We'll be happy to help you out.